You send over some really interesting material for this deep dive. It looks at the global economy, U.S.-China stuff mainly, but then pivots to the Philippines too.
Yeah, there's a key report from Jefferies, The Lack of Leverage, from just a few days ago, April 17th.
Right. And articles from the Wall Street Journal, South China Morning Post, FT, others, all recent,
Yeah,
plus economic data.
exactly. The idea is to get a handle on the current economic picture, where the power might be shifting.
Okay, let's dive in. That Jefferies report titled The Lack of Leverage kind of gives the game away, doesn't it?
It definitely sets the stage. It directly challenges the idea that the U.S. has all the cards when it comes to pressuring China on trade.
So the big question they pose is, does the U.S. president really have an ace up his sleeve here?
And their answer seems to be, maybe not. Or at least the hand isn't as strong as many assume.
What's the core argument?
It boils down to household savings. It's quite a structural point they make.
Savings. How
Yeah.
so?
Well, look at the numbers they present. In the year leading into early 2025, Chinese households were saving almost 32% of their disposable income.
32%. Wow. Okay, and the U.S.?
Just 4.3% in the year up to February 2025. That's what their Exhibit 1 shows. A huge gap.
That difference is massive. So how does China saving so much translate into less leverage for the U.S.?
Well, think about where that money goes. Lower U.S. savings means the U.S. relies more on foreign capital. It contributes directly to the U.S.'s net international investment position, the IIP.
Ah, right. The country's balance sheet with the rest of the world.
Exactly. And by the end of 2024, the U.S. deficit there was enormous. U.S. $26.2 trillion. That's like 90% of U.S. GDP. Exhibit 2 lays this out.
90%. So basically, the U.S. owes the world a lot more than it owns abroad.
Precisely. And being that reliant on foreign funding inherently limits how much pressure you can realistically apply. It's a vulnerability.
Okay, so that's the savings and investment angle. But what about the dollar, the reserve currency status? That's always been the ultimate safety net, hasn't it?
Traditionally, yes. But the report points to some unusual market action recently that might be chipping away at that idea.
What kind of action?
Well, Exhibit 3 highlights this. Typically, when markets get nervous, risk-off investors run to the U.S. dollar and U.S. Treasury bonds for safety, prices go up.
Right, the classic flight to quality.
But lately, we've seen instances where stocks are shaky and the dollar and treasuries are weakening at the same time.
Oh, that is unusual.
Very. The report notes it's been rare over the past 30 years. Even during big crises, Asian crisis, LTCM 2008, even the COVID panic in 2020, the dollar usually got stronger in those risk-off moments.
So the fact that it's not happening now,
Mm.
what does that suggest?
It suggests the market might be, perhaps, starting to question the dollar's role as the ultimate, unquestioned safe haven. At least that's the implication.
And this is happening around the same time as all the back and forth on tariffs from the Trump administration.
Exactly. You had the tough talk, then sudden exemptions for things like smartphones and computers.
But then almost immediately, talk of a new national security investigation into semiconductors and electronic supply chains.
Right. Which could lead right back to more tariffs. The main result, as the report puts it, is just uncertainty. And markets hate uncertainty.
Yeah, businesses can't plan. It feels like this market weirdness, the weakening dollar and bonds, might be linked to that policy whiplash.
It's certainly plausible. The timing is suggestive. And it makes you reconsider things like that old argument blaming a global savings glut for the U.S. subprime crisis.
Ah, yeah, that always felt a bit convenient, didn't it? Blaming others for saving too much.
It did seem a bit like tortured logic. Now, maybe the market itself is just reacting more directly to the U.S.'s own internal imbalances and policy choices.
So this uncertainty isn't just theoretical. The report says U.S. companies are actually delaying decisions, cutting orders.
That's what they're hearing, yes. And you see the knock-on effect in consumer sentiment. That University of Michigan index, Exhibit 4, shows it just plunged.
How bad is it?
Second lowest level on record. It dropped from 74 in December down to just over 50 in early April. A really sharp fall in confidence.
Ouch. And that's showing up in growth forecasts, too.
It appears so. Look at Exhibit 5, the Atlanta Fed's GDP Now model. Just a couple of months ago, early February, it was projecting almost 4% annualized growth for the first quarter.
Right.
Now, it's forecasting a 2.2% annualized contraction, a complete reversal.
Wow, from 4% growth to a 2% contraction forecast in just 2 months? That's significant.
It definitely grabs your attention, and it feeds into arguments like the one in that Wall Street Journal piece you mentioned.
Right, the one suggesting Trump should scrap the current tariffs, maybe go for a universal import tax, and focus on tax cuts and deregulation instead, kind of a reset.
And interestingly, the Jefferies report seems to broadly agree with that kind of analysis, at least directionally. They state pretty clearly that tax cuts and deregulation are generally bullish, while tariffs are bearish for growth.
It seems tariffs might even be pushing other countries together, perhaps unintentionally.
There's evidence of that. The South China Morning Post reported EU officials are heading to Beijing soon, in July, and there are whispers about talks to end the EV tariffs.
Potentially in exchange for something like tech sharing.
That's the speculation. It plays right into what many see as Beijing's long-term goal, trying to create a bit more distance between the Eurozone and the U.S., particularly the sort of anti-China elements in Washington.
So Trump's tariffs, aimed at pressuring China, might actually be helping China achieve that goal with Europe.
It's certainly an ironic possibility, yeah. The law of unintended consequences.
Okay, so the economic leverage seems questionable. What about military leverage? Does the U.S. still hold the clear advantage there?
Well, the report raises questions about that, too. They argue that a more isolationist U.S. foreign policy under Trump, combined with what the Ukraine conflict revealed.
What did it reveal?
Things like U.S. military dependence on some Chinese components and just general supply chain issues and shortages. It suggests the U.S. might not have the same unchallenged dominance it once assumed.
And China's manufacturing base plays into this.
Hugely.
Uh-huh.
Exhibit 6 is quite stark. China accounts for about 32% of global manufacturing output by volume now.
32%.
That's more than the U.S., Japan, Germany, and South Korea combined. That industrial capacity is a major source of power, military and otherwise.
The report also mentions something about drones changing the game.
Yeah, a fascinating point. The rise of cheap, effective drones might be reducing the strategic importance of hugely expensive platforms, like traditional aircraft carriers. It potentially levels the playing field somewhat.
And China has pushed back directly on the trade front too, right? Not just waiting it out.
Oh, absolutely. They've retaliated.
Yeah.
The most pointed example is restricting exports of rare earths,
Which are critical for U.S. tech.
especially military tech. That Fox Business article quoted Mark Smith, the CEO of NeoCorp, talking about how essential they are for things like U.S. Air Force jets. Hitting rare earths is hitting a key vulnerability.
This all seems to reinforce that Jefferies' long-term view, the emperor has no clothes thesis,
Yeah.
it seems more relevant now.
It does.
Hmm.
And they mentioned their portfolio reflecting this caution for a long time. Exhibit 7 shows a 40% weight in gold bullion since way back in 2002.
40% in gold since 2002. That's conviction.
It was definitely contrarian for a long time, but the recent market reactions are making that stance look, well, pretty prescient.
So if tariffs stay or uncertainty continues, what's the likely path for the U.S. economy according to them?
Their base case seems to be continued U.S. underperformance relative to other markets, a weaker dollar, and probably a tough environment for U.S. treasuries, a bearish bond market.
They mention Elon Musk and DOGE. How does that fit in?
Yeah, it was a brief mention, more illustrative. I think the point was just highlighting potentially frothy or speculative behavior alongside signals like reduced federal spending cut targets as things that don't bode well for long-term treasury investors needing fiscal discipline.
Okay, so investment-wise, what does this outlook lead them to suggest?
For investors with long-term dollar exposure, they lean towards investment-grade corporate bonds over government bonds.
And for global investors?
They suggest maybe trimming U.S. equity positions. U.S. stocks look expensive to them, trading around 19 times forward earnings. They favor looking towards Europe, China, and India instead. That's in Exhibit 8.
Are there warning signs in the U.S. market itself?
They point to a couple. Record high foreign ownership of U.S. equities at the end of last year. Exhibit 9 shows that. And also, Exhibit 10 shows U.S. households have a record high allocation of their own financial assets in U.S. stocks. Historically, those peaks in allocation can be bearish signals.
Interesting. Let's switch to Europe then. Any potential bright spots or changes there?
Well, the big question mark is German fiscal policy. There seems to be some movement.
How so?
Exhibit 11 notes they've revised their debt break rules. This potentially allows for a huge increase in spending, maybe $900 billion, mainly on defense and infrastructure.
That's a lot of potential stimulus.
It is. And then there's the ongoing debate sparked by Mario Draghi's report about the Eurozone's massive investment needs, maybe $750, $800 billion annually.
Is there political will for that kind of spending, especially joint borrowing?
That's the key. Figures like Friedrich Merz in Germany were initially resistant to anything like Eurobonds. But if Germany does become more open to joint EU debt to fund these investments, That could be a really significant positive catalyst.
Bullish for European stocks and the euro.
Potentially, yes. And Exhibit 12 shows the euro has already gained quite a bit against the dollar since early February, over 12%, so there's already some momentum there.
And amidst all this, gold keeps climbing.
Yeah. Exhibit 13 points out it's been hitting new highs, but maybe without the huge media frenzy you might expect.
Which they see as potentially bullish, like it hasn't gotten overheated yet.
That seems to be their interpretation, yeah. Still room to run, perhaps, as a safe haven.
Okay, let's make that pivot to Asia we talked about, specifically the Philippines. Why are they highlighting it?
They see it as a market that could benefit from a weaker dollar and potential Fed rate cuts, partly because it's less reliant on goods exports than some other Asian economies.
How much less reliant?
Exhibit 14 shows goods exports are about 16% of GDP. That's quite low for the region, actually similar to India's level, so it's maybe a bit more insulated from global trade fights.
But the political situation there sounds complicated.
It definitely is. You've got President Marcos, who's shifted policy to be more pro-U.S. compared to his predecessor Duterte, who leaned towards China.
And Duterte himself was recently arrested.
Yes, arrested in March, facing extradition to The Hague over charges related to his time in office. This has really ramped up the feud between the Marcos and Duterte families.
Including going after his daughter, the vice president.
Exactly. Impeachment proceedings against Vice President Sara Duterte, who is Marcos's running mate, but also Duterte's daughter. It's quite tangled.
How's that playing out in public opinion?
Polls in Exhibit 15 show Marcos's approval rating taking a hit after Duterte's arrest, while Sara Duterte's popularity actually rose.
So yeah, definitely signs of political instability.
Okay, unstable politics. But what about the market itself? Is it attractive? That's the interesting counterpoint. Despite the politics, the Philippine stock market, the PSCI, looks cheap, according to the report. Exhibit 16 shows it trading well below its historical average valuation.
And foreign investors.
Record low ownership, basically. Exhibit 17 shows foreign ownership was just over 19% in March. So foreigners aren't crowded into this market right now.
And the central bank is helping things along.
Yes, Banco Central in Pilipinas, the BSP, has been easing policy. They cut rates again in April, bringing total cuts to 100 basis points since last year. They've also cut bank reserve requirements. That's in Exhibits 18 and 19.
Is inflation a concern?
Actually, no. CPI inflation was only 1.8% in March, which is below the government's target. Falling rice prices helped bring it down.
And the currency.
The Philippine peso has actually been strengthening against the U.S. dollar, as Exhibit 20 shows. So easing policy, low inflation, a strengthening currency, that's a decent mix.
So underlying economic picture, is it holding up despite the politics?
It seems reasonably resilient. Earnings growth forecasts for companies are decent, around 10% for 2025, with a solid dividend yield and return on equity.
What about growth overall?
Economic growth was over 5% year-on-year in the last quarter of 2024. Household consumption is strong, up nearly 5%, helped by strong growth in consumer loans. Exhibit 21 covers this.
Are those loans going bad?
Actually, the non-performing loan ratios for consumer loans have been improving, which is positive. Exhibit 22 shows that. And overall bank lending growth is picking up too, according to Exhibit 23.
What's driving consumption?
Things like falling rice prices, helping household budgets, minimum wage hikes, and probably some spending related to upcoming elections too.
Are there weaknesses? What about those twin deficits you hear about?
Yes, the Philippines does run both a trade deficit and a current account deficit. Exhibits 24 and 25 detail those. They are significant. But the fiscal deficit has actually been narrowing, which is good news, Exhibit 26. And crucially, money keeps flowing in from overseas workers' remittances, which were up again last year and early this year, Exhibit 27.
And the BPO sector, business process outsourcing.
Still very strong. Generated US $38 billion last year, up 7%. Despite all the talk about AI risks, that sector seems incredibly resilient and a key pillar for the economy.
Okay, so a complex picture in the Philippines. Finally, did the Jefferies report mention any specific changes they made to their own portfolios based on all this?
Yes, a couple of notable ones. In their global government bond portfolio, they're adding back a 15% weighting to China's 10-year bonds.
Interesting, despite the tariff headwinds for China.
Yeah, they funded it by selling Abu Dhabi and reducing Indonesia bonds. Exhibit 28 shows the change. They acknowledge the tariff impact, but note that exports to the U.S. are actually a pretty small part of China's overall GDP. Exhibit 29 touches on China's nominal and real GDP growth, which remain fairly solid.
Any changes in their Asian portfolio?
A tweak there, too. In their Asia-Pacific ex-Japan relative return portfolio, they increased their India weighting slightly, funded by trimming Taiwan a bit more. Exhibit 30 details that, reflects that relative preference shift.
Okay, so let's try to wrap this up for you, our listener. It seems the big picture is one where the U.S. is facing some real economic challenges, maybe less leverage over China than assumed, driven by those deep imbalances in savings and investment.
Right, and the tariff policies are adding a layer of uncertainty, potentially even pushing other global players like Europe and China a bit closer in some ways.
And that unusual market reaction, the dollar and bonds weakening together, sometimes it might be signaling a subtle shift, a questioning of the dollar's absolute dominance.
Meanwhile, Europe has its own issues, but there are potential positive triggers, especially if Germany loosens the purse strings on fiscal policy.
And the Philippines stands out as, well, an interesting mix. Politically messy, yes, but with the cheap stock market, easing monetary policy, and solid domestic demand.
Yeah, and underlying all this, investment strategies are clearly adapting, shifting allocations between regions and asset classes to navigate this changing world.
Which brings us to a final thought for you to chew on. Given everything we've discussed, the economic pressures, the trade tensions, the shifting alliances, the market signals, what do you think are the most important long-term consequences of all this for global trade and investment?
And maybe more intriguingly, what kind of unexpected curveball could come along and completely change this picture we've just painted? The connections are complex, and things rarely play out exactly as forecast.
Definitely something to think about. Thanks for diving deep with us today. We'll catch you next time.